Hello and welcome to this fund manager interview here at Freetrade. Today I'm joined by Fcit manager Paul Niven to talk about the trust and give investors a little bit of an idea of what they're doing over at F&C. If you haven't signed up to Honey, our daily market newsletter, be sure to do that in the link below for daily news on the markets every single day. With that, Paul, thanks so much for joining us. I thought we could start off by talking about Fcit. In general, what are you trying to achieve?
So the overriding objective of F&C Investment Trust is to deliver growth in both long-term capital and also income for shareholders. Our aim is to provide a one-stop shop for investors looking for exposure to both public and private equity assets. So today we've got around 90% of our portfolio in listed equities and around 10% in unlisted private equity opportunities.
Excellent. Yeah, and I think we might come back to that split later on. But I mean, initially, does that mean that are you drawn to kind of, are you a growth manager, are you a value manager, or a bit of both? How do you approach the market?
So we adopt a diversified approach, and that means that we source and select a range of underlying investment strategies, which are both global and regional in nature. Obviously, one can categorize different strategies by virtue of their growth characteristics or value. We actually have both. And one of the advantages of that is that these strategies that we have in the portfolio are differentiated against each other. And that provides benefits through diversification. So having both growth exposure and value exposure in the US will enable us to smooth returns in the longer term for investors.
And I think looking at the holdings, it's quite fun to look at them because you've got the big names in there. I think the top 5 or 6. There's a lot of tech exposure. But then you get names like international flavors and fragrances. Now that's slightly different from your Apples and your Facebooks. How do you decide which companies make it in?
The process that I'm responsible for is overall portfolio composition, and that is selecting underlying strategies, managing that exposure. Underlying stock selection decisions are undertaken by specialists, either within the group or in a few instances by a third-party manager, where we essentially give a portion of capital to a specialist manager to undertake stock selection. And that is the case in the US, for example, where we employ T. Rowe Price to select growth stocks for us. They're a Baltimore-based manager, and Barrow Hanley, based in Dallas, they select value names for us. Obviously, more lowly rated, perhaps slightly more slowly growing, but attractively valued relative to fundamentals. Just very briefly on international flavors and fragrances, it is an interesting name. It's perhaps less familiar than some of those big disruptors which you mentioned. We actually hold that in a couple of areas in the portfolio, so it does appear quite high up in the overall list of names that we have. And that stock benefits from long-term health and well-being trends related to nutrition, which are being well supported by both regulation and also consumer demand. Those shares trade at a discount to peers in the space, and we think offer a very attractive valuation and decent margin of safety.
And I was going to ask you about, do you have a specific stock that tells a story of how you run things? It seems to me, are they quite important facets to you? Things like margins of safety, decent valuation, thematic exposure.
Absolutely. Well, I think in reality, when you look at our portfolio, you will see a range of stocks from those big names like Apple and Amazon through to perhaps less familiar names. And each manager at the underlying portfolio level will be looking for slightly different attributes. But we like that, as I said, diversifying approaches. So long as managers of skill, that will add to returns and reduce risk. And there's more than one way essentially to be right. One needn't be too dogmatic about precisely what one is looking for in aggregate. But that said, each manager does something quite specific. But what I would say is, in general, we're looking for companies which are ticking a number of boxes, attractively valued relative to fundamentals, strong competitive market position versus their peers, and also with strong management. And depending on the strategy, the emphasis will change. So again, a growth manager will be looking for placing more emphasis in terms of growth rate in revenues or cash flows, whereas others will, to come back to this point about margin of safety, will be a little bit more value oriented and looking for companies which might be a bit slower growth in terms of fundamentals, but are perhaps mispriced. And another angle, which is of increasing importance, is the responsible angle. So we seek to be responsible investors, and the primary way in which we achieve this is through engagement. But there are some areas we will not invest. So thinking about stocks that areas we will invest in, but also areas we won't invest in. So we won't invest in areas such as thermal coal, given climate considerations, controversial weapons, and also tobacco.
And just on that sustainability angle, I mean, I think people see that if you have an ESG element to your investment strategy, it's nearly like you're some kind of tree hugger. But it's not. You don't have to be, do you? It's about sustainability. Is just about sustainability of returns as well in flourishing industries.
Absolutely. I mean, like, sustainable business practices tend to be good business practices, and businesses which act responsibly tend to have higher quality metrics, whether it is labor standards, environmental considerations, and actually in many instances that leads to better shareholder returns. So there is a quite high correlation actually between the notion of investing for good and investing responsibly, and this notion of quality and high quality businesses. High quality businesses do tend to consider those aspects, which are really very important from a responsible angle. What I would say, and just going back to this point, there's a continuum, as it were, in terms of responsible investing. And from our perspective, we do have some components in the strategy which are explicitly focusing on sustainable outcomes and really good business practices, companies that are well aligned to UN Sustainable Development Goals, essentially doing good more broadly. But we do take our responsibilities in terms of voting and engagement really seriously. And you look at our portfolio, and we do look at metrics in terms of alignment to carbon, for example. We've made a net zero commitment, and we'll engage with companies in order to deliver better outcome for shareholders through better business practices, and considering those broader metrics which I mentioned, such as the environment.
Yeah, good. Great to hear. And I think you mentioned the US exposure through T. Rowe Price on the growth stocks there. It's not the only geography represented in the portfolio. I was thinking, are there any other geographies you're particularly drawn to? And maybe you could give us a view as to, your view on China at the minute. There's so much exciting stuff in the past few days that's come out around what's happening there.
Yeah, it's really interesting. So we've got, if you look at the aggregate portfolio, there's around 60% of the portfolio invested actually into into US listed companies, if one just looks at the listed exposure, and there's a little bit less than that if you incorporate private market exposure. But the majority of our holdings actually have a US listing. Next biggest area is going to be for us Europe, and we obviously have exposure to other areas like Japan, emerging markets. So we think there's good opportunities everywhere. The US has been an area that has notably outperformed for the last decade or more, and that people talk about valuations on US markets, and obviously they trade at a premium, but the reason that the US trades at a premium is partly to do with the superior earnings growth that's been delivered from that area, the high margins for many of the leading companies in that space. So it's traded richly, but for good reason, because of the very strong fundamentals. But there are other interesting opportunities outside of the US. You mentioned China. What I'd say on China is China is an area of increasing importance. Obviously, from an economic and a macro perspective, it constitutes a large and increasing portion of the global economy, and an even larger part of the global growth picture. It's also becoming more and more important in terms of listed markets. However, one has to exercise an element of caution, clearly, with regard to the regulatory backdrop. And obviously there's been, not just in the last few days, but over recent months, and even looking back into last year, there have been some warning signs that perhaps China is becoming a little bit less tolerant of some of the practices of some of the businesses which are either looking to list or are already listed, and indeed some of the individuals that are involved in running those businesses. So it is concerning, is what I would say. I don't think it's going to derail the growth in China in terms of importance from a broader market perspective. It is already bigger than the UK in global market indices, right? And it's fast closing in on Japan.
The chatter seems to have flitted from US tech, maybe earlier in the year, to kind of the lowly valued UK companies. And I guess this maybe suits the style, Paul, because you've got those growth elements and value elements that they've been handing the baton in Q1 and Q2. But I think in all of this, Europe is being largely ignored, but you do have European exposure. What's your thesis there?
It has been a poor grower in terms of the region more broadly, and the corporate sector has lagged quite materially behind in terms of growth in earnings. From a generalized perspective, I think if you take a step back and think about the environment that we are in, it is one whereby the global growth momentum is accelerating. Growth is more abundant globally than it was 12 months ago. It wasn't that long ago that we were really concerned about what 2021 was and beyond was going to look like from a growth perspective, and growth is much more abundant. It's been tremendous upward revisions, and that reflationary environment, which has largely played out over the last 9 to 12 months, albeit in the last few weeks or so has taken a bit of a breather. That is an environment which actually should be a bit more conducive to European equity performance, and there's some glimmers that we're beginning to see that actually in 2021. So what is the thesis for European equities? Well, firstly, Europe trades at quite a material valuation discount to the US. Now, partly that is due to this fact that the US has delivered just far superior outcomes in terms of earnings growth than has Europe. The composition of the European market is in broad terms a bit more cyclical than what you tend to see in the US. And what I mean by that is it's a little bit more geared to the economic cycle, and therefore if you're thinking there's an upswing, then you get a bit more leverage to that. And partly that's to do with the financial sector. So European financial sector, the banking sector, didn't really clean itself up, or was not cleaned up in the way that the US was, and therefore it has lingering issues. But nonetheless, if we're in an environment where inflation expectations are rising, where bond yields are backing up somewhat, where growth expectations are rising, then actually it tends to be a relatively good environment for financials, and one in which Europe would also tend to perform a bit better. So yeah, we do have a reasonable exposure to Europe. I tend to think, my view is that the performance in equities is going to be more balanced going forward than what people have been used to in the last few years, where it was all about the US, all about disruptive tech.
So Paul, turning to the trust itself now, it's probably fair to say that we probably wouldn't have investment funds at all without Fcit. I think I read somewhere that the trust came along before zip fasteners, and it came in just in time for traffic lights and things. How important is that trust structure in what you're trying to do? I think you mentioned access to private equity as well there.
The structure of the trust is really important, and the trust was launched in 1868, so it's been around for over 150 years. And one of the reasons that the trust has survived for as long as it has is really the robustness of that closed-ended structure and the benefits which it actually confers for shareholders. So it's really, really important, I think. Being a closed-ended fund, we don't have to deal with daily inflows and outflows, and that means that we can invest with a long-term perspective and also take illiquidity on the portfolio, which means we can buy less liquid assets like private equity, lock up capital on a multi-year basis. We can also borrow to invest. So as a company, a listed company, We can undertake long-term borrowings, and we recently undertook some long-dated borrowings out for 35 years. Very, very attractive rates of interest. Blended rates on that borrowing that we recently undertook, 2.2%. So if we can make an excess return above that 2% or thereabouts, it's going to enhance returns for shareholders over a very long time period. We also, and this is really important, put some of our income into revenue reserves in the good times, and that helps to smooth dividends. So we've got very substantial revenue reserves, and that has enabled us to pay a dividend every single year since 1868, and also a rising dividend to shareholders for 51 consecutive years. So if you think about last year as one example, big downturn, collapse in earnings, collapse in dividend payments, and yet the trust managed to pay a rising dividend to shareholders. That's a function of the revenue reserve that we have in place, which enables us to smooth income for our shareholders. And the final point I'd make is, and again, it's very important, is as a listed company, and we sit just outside the Fcit 100, we have an independent board of directors, and they look after the interests of shareholders. So they do the right thing from a shareholder perspective, and ensure that the company is delivering attractive returns.
Yeah, I think that income aspect is extremely important. I mean, you're a fully paid up member of the Dividend Heroes. Just thinking about that, and thinking about, I mean, you mentioned the accessibility of that long-term capital. I would imagine that's to perform something that investors might know as gearing, where you can invest more and try and amplify returns. Obviously, it goes the other way, which you never wanted to.
Yep.
It can increase losses, but some of the aspects of trusts people really aren't sure about, and I think there's a couple of facets there, especially the income would lend themselves to certain types of shareholders with their certain types of aims. Who do you think will be attracted to a trust like Fcit?
It's a really good question. So our exposure, as I said, is diversified. It's global in nature. It's growth assets, listed equity, and private equity. So the short answer is it's investors that are looking for diversified exposure to growth assets, and one would expect, certainly from our perspective, attractive returns on a long-term basis from listed equity and private equity. But the way in which we invest, that diversified nature, means that we're ideal in terms of providing a cornerstone to a portfolio. Again, we don't place too much risk in one particular area, and that means as a bedrock of the portfolio of growth assets, we think we can fulfill a very useful role. And to this point on income, we're not a high income trust. Our dividend yield is 1.5% or thereabouts. But this ability to deliver not only dividends, at least historically, every year since launch, but 51 consecutive rises, and the prospect of capital growth as well, means that I think it's a very attractive proposition for those investors that are looking for growing income through time, and are looking also to have some return on their capital.
Paul, a really useful insight into the trust. Thanks for joining us. I'm looking forward to talking to you again in another 150 years. And thank you very much for watching. Again, if you want to find out more about Fcit or any of the trusts on the platform, visit the app. And don't forget to sign up to Honey, our daily market newsletter, for more news from the markets every day. Thanks for joining.